The comic strip here is your money back if and when we feel like it. I know many investors feel that way about their investments. They just kind of hope and pray that it works out because, frankly, you're relying upon the company or an investment advisor for their judgment and their ability to add value to your portfolio. The components of this chapter, chapter 9, are looking at the elements that comprise the sources of capital, which are debt, preferred stock, and common stock. Then look at the computation of weighted average cost of capital, look at some factors that impact the WACC for a given company, and then we'll look at adjustments. We'll look at it for risk level, we'll look at it for divisions, and we'll look at it for considering flotation costs, which is the cost of raising money. In this bottom section here, which represents the weighted average cost of capital, comprised of a component for cost of debt, a component for cost of equity, and each of those are determined, hopefully, by market conditions. Although sometimes we rely upon book value because of convenience or it's the only information we have, remember that the ideal use of WACC is where it reflects the expectations of the marketplace, not some historical measure like the historical price or yield to maturity on a bond, but rather what bondholders today expect from the company. All right, so which are and are not sources of long-term capital? We've gone through this quite a bit. First, from when we look at free cash flow, determining the operating components of the balance sheet. And now we're looking at it from the standpoint of the providers of capital. So we're on the flip side. This may seem redundant, but it's such an important topic, it's worth doing just one more time. What are sources of long-term capital? Think of it as money from financial investors. It's not from a vendor. It's not from your employees. It's not from a commissioned salesperson. It's from people whose business it is to provide capital to the company, whether that's for debt or equity. It's comprised typically of long-term debt, and this would be loans payable, notes payable, bonds payable. That's what we refer to as long-term debt. Short-term debt is kind of a close situation because it is clearly debt provided by a bank, but we normally exclude it because it is part of the operating requirements for the company, because it gets the company through its seasonality, like companies that are heavily dependent upon holiday shoppers, or it could just be the normal ebbs and flows of a business, cash conversion cycle of buying inventory, holding receivables, etc., which may or may not have anything to do with seasonality, but just the flow of the business. Preferred stock, obviously another source of capital for the company, but as we've seen before, it's a hybrid, having both characteristics of debt, like regular payments, and characteristics of equity, like some upside and a market value. Also convertibility. Most preferred stocks may be converted to common. Common equity, of course, is the residual owner. Every company has it, and that's an obvious source of capital for any corporation. On the right side are those things that are not sources of long-term capital. And we've talked about these as operating. And so we looked at accounts payable, which are from vendors, accrued liabilities, which could be from landlords or employees, deferred taxes, which is income tax authorities. And finally, we look at these, whether they're at projects or not. So this is a kind of a complex aspect of a company is comprised of business units. The business units are comprised of projects. And what is the appropriate discount rate or rate of return for projects? And if you think about it, each project has its own set of risks. Some projects may be high risk, some may be lower. So this is a topic we'll delve into further, but let's just stay at the company level for now to determine the company's weighted average cost of capital. All right, so let's look at before tax versus after tax. This is an important adjustment when we make the computation of weighted average cost of capital. And the simple answer here is that debt, because we pay interest and interest is tax deductible, we have a lower cost than the stated interest rate because we get the benefit of direct offset to our taxable income. So we need to make an adjustment only for the debt components. Interest is deductible, therefore we can do an adjustment. That adjustment is very simple. We've done it many times. It's simply 1 minus the tax rate. Whereas payments we get or pay to shareholders are not tax deductible, so therefore there is no tax adjustment. And just a simple example to help you visualize this, if a company pays $100 in interest to a bank, the company gets to deduct that $100 against their other operating income. And because of that, when you apply a tax rate of say 40%, we're saving 40% of 100 because we were able to deduct 100 from the taxable income prior to considering the interest. However, if a company pays $100 in dividends to its shareholders, that is not a deduction for tax purposes. Rather, it's seen as return of capital to the shareholders or some yield for investment return for investors. So it has nothing to do with an operating expense by tax law. So that's why there's this important distinction when we do the WACC calculation, that there is a 1 minus T adjustment for debt, but not a 1 minus T adjustment for equity.